Welcome back to Retirement Wealth Blueprint, your channel for achieving financial freedom and making those retirement dreams a reality. Let's build that dream retirement together, starting today. This content is for informational purposes only and does not constitute financial advice. Let's talk about one of the smartest ways to keep Uncle Sam's hands off your hard-earned money in retirement: tax-free accounts. I'm talking about the Roth IRA and Roth 401k. Here's why I love Roth accounts. First off, you pay your taxes up front. But here's the beautiful part. When you retire and start taking withdrawals, that money is 100% tax-free. It's like a gift from your younger self. And get this, no required minimum distributions, RMDs. You decide when and how you take your money. Roth IRAs grow tax-free forever. That means all those gains, all those dividends, they compound and grow without the taxman taking a cut. Now here's a pro tip from yours truly. If you're still working and have a traditional IRA or 401k, look into doing a Roth conversion. You'll pay the taxes now, but guess what? Tax rates are historically low right now. This way you lock in those lower rates and enjoy tax-free income later. Retirement is about enjoying the fruits of your labor, right? Well, where you choose to live can make a huge difference in how much of that hard-earned money you actually get to keep. I'm talking about moving to a state that respects your money, a low-tax or even a no-tax state. Believe it or not, there are states out there that don't have a state income tax. Let's talk about some of the top contenders. Florida. The Sunshine State is a retiree paradise for a reason. No state income tax, beautiful beaches, warm weather year-round. Then there's Texas. The Lone Star State has no state income tax either, which means more money stays in your pocket. And don't forget about Nevada, Tennessee, and South Dakota. These states also have no state income tax, giving you more financial freedom to enjoy your retirement years. Now here's a little pro tip for you. When you're considering a move, don't just look at income tax. Check out property taxes, sales taxes, and even things like estate taxes. You want to make sure you're getting the best overall deal for your money. Are you invested in the stock market? Real estate? Good for you. Those are smart moves for building wealth. Here's the deal. When you sell an investment that you've held for over a year, you qualify for lower capital gains tax rates. And get this, if your income is below a certain amount, $44,625 for single filers, $89,250 for married couples filing jointly, your long-term capital gains tax rate is a big fat 0. That's right, you can keep every penny of your profits. Here's another little gem, the step-up basis rule. This little beauty allows you to pass on your investments to your heirs tax-free. It's like leaving a legacy of wealth without the tax burden. You've worked hard, saved diligently, and now it's time to enjoy the fruits of your labor. But hold on a minute before you start cashing in those retirement accounts. The way you withdraw your money can make a huge difference in how much you pay in taxes. Think of your retirement accounts like buckets of money. You've got your taxable accounts, stocks, dividends, savings, your traditional 401k or IRA, and your Roth IRA. Each bucket gets taxed differently, so you want to withdraw from them in the right order to minimize your tax liability. Here's the best withdrawal order to keep more money in your pocket. First, dip into those taxable accounts. Next, withdraw from your traditional 401k or IRA. Remember, this money is taxed as ordinary income, so you want to keep these withdrawals low to avoid bumping yourself into a higher tax bracket. And finally, save your Roth IRA for last. This is your tax-free bucket, so you want to use this money for larger expenses or when you need more income later in retirement. Now listen up, because this is where most retirees miss out on big savings. I'm talking about tax credits and deductions. These are like hidden treasures in the tax code, and they can put serious money back in your pocket. First up, let's talk about medical expenses. We all know healthcare costs can be a real drain in retirement. But here's the good news. You can deduct medical expenses that exceed 7.5% of your adjusted gross income, AGI. Next, let's talk about charitable giving. Are you passionate about a particular cause? Do you believe in giving back to your community? Well, here's another great way to save on taxes. Donate to qualified charities. You can deduct up to 60% of your AGI for cash donations and even get a deduction for non-cash donations like clothing or household goods. And for those of you who are still working and contributing to retirement accounts, listen up. You may qualify for the Saver's Credit, which gives you a tax credit of up to $1,000, $2,000 for married couples filing jointly, for contributions to your IRA or 401k. Here's a pro tip. Keep good records. Make sure you're tracking all your medical expenses, charitable donations, and any other expenses that you might be able to deduct. Let's face it, folks. Medical expenses can eat away at your retirement savings faster than a termite in a lumber yard. But don't worry, I've got a secret weapon for you, the Health Savings Account, or HSA. This little beauty is like a triple threat against healthcare costs. Here's how it works. Contributions to your HSA are tax deductible. The money in your HSA grows tax-free, just like a Roth IRA. But here's the best part. When you use that money for qualified medical expenses, those withdrawals are tax-free too. It's like a trifecta of tax savings. Here's a pro tip. Maximize your HSA contributions. The more you contribute, the more you can potentially save on taxes, and the more you'll have available to cover those inevitable healthcare costs in retirement. Look, nobody likes paying more taxes than they have to, especially in retirement when you're supposed to be relaxing and enjoying the fruits of your labor. But the good news is, you don't have to. With a little planning and the right strategies, you can legally reduce your tax burden and keep more of your hard-earned money right where it belongs, in your pocket. Let's do a quick recap of the tax-saving strategies we covered today. First, remember the power of Roth IRAs and Roth 401ks. These accounts offer tax-free withdrawals in retirement, which can save you a bundle. Second, consider moving to a low-tax or no-tax state. Now I want to hear from you. Which tax-saving strategy are you going to implement today? Drop a comment below and let me know. And don't forget to like this video, subscribe to my channel for more wealth-building tips, and hit that notification bell so you never miss a life-changing video.